Hey everybody, Preston Brent here with our weekly roundup. This is for the trading week ending October 19, 2018. So, very interesting series of weeks here. Before I jump into my chart here, which I'm showing on the screen, a weekly time frame of the E-mini S&P 500 futures. This week we've seen a couple of things happen. Good old Sears and Roebuck goes way back. They went bankrupt this week. We also saw news where the U.S. deficit grew 17% to about 780 billion. And then we've seen some more geopolitical risk surface with Saudi, the Saudis and the killing of Khashoggi over in the consulate over in Turkey. So we've seen a number of things out there, obviously enough to roil the markets a little bit. A lot of people are saying, well, gee, why did the Saudi killing there kind of roil the markets? Well, they've got this Tuesday supposedly is the Davos in the desert, the Saudi Arabian hosting their financial conference. And we're seeing a lot of people canceling that conference. And just keep in mind that the Saudis have invested hundreds of billions of dollars in U.S. infrastructure, technology, buying a lot of defensive military product, and oil. So the Saudis are deeply entrenched, not only in the U.S., but globally as far as where money flows. So I think part of this was the fear, not so much of the killing, but of the retaliation. And will the U.S. go too far? How will that affect the Saudis? Because the Saudis came out initially and said, if you impose sanctions or do anything against us, then we're in turn going to do something against you. And that kind of is what roiled the markets in the geopolitical front. So those are just some of the things that kind of came to the forefront this week. Now, in all of that, we've seen wide swings in the indexes. The Dow at the end of the week finished up 39 basis points, almost where it started. The same thing with the S&P. The cash index was only up 2 basis points. So with all the wide swings, essentially both the Dow and the S&P were flat. Nasdaq was down about 64 basis points. Now it was down last week 3.74%. So technology, clearly money is coming out of the tech sector in the FANGs and a few others, and then rotating into other sectors like utilities and value areas of the market like consumer staples. We also saw this week the VIX come down about 9.4%, still elevated at 19.89. Last week it finished at 21.97, but still relatively high. But as I said in the title to my weekly roundup this week, it's all about interest rates versus corporate valuations. I tell my members over and over again, over a longer term basis, money goes where it's most appreciated. And it's driven by interest rates, primarily the U.S. rates. The U.S. is the only economy outside of maybe Germany where the 10-year interest rate is considered a risk-free investment. Now, nothing is absolutely risk-free, but about as risk-free as you can get on this global planet in capital markets is the 10-year U.S. So when that interest rate starts going up, then money, big money, says, well, if I'm getting a higher interest rate there, then how much more interest will I earn or appreciation will I earn by owning equities? That is called the risk premium. How much am I willing, how much do I demand in a risk premium to own equities versus the standard bearer, the 10-year? So at a very high level, these things are going on, and that affects forward PE ratios, because as interest rates go up, a little bit of money comes out of equities, goes into some of the more risk tolerant or risk less investments. So we're seeing that happen. The PE ratio this Friday ended at 15.9. Okay. Now understand the average rate going back long term is around 15. So we're getting a lot lower than where we started this year. We started January at 18.6. And as you can see on the screen here, back over in this area here, the PE ratio was at 18.6. Money was willing to pay more for a higher forward guidance on the idea that the markets were going to be stronger. And now we're lower than we were in January of this year. And the PE ratio, the price to earnings, is at 15.9. So even though the prices are lower, the PE ratio is a lot lower at 15.9. Now, the reason why the forward PE ratios are going down is interest rates, as I said, are going up. So money is forcing this to happen. At some point, there is going to be a fair value in the markets. This fair value is where we're going to start to see consolidation longer term and then a move higher, assuming earnings continue to come out very strong. Now, so far, we've had about 72% of companies report their earnings as of October 19 in this earnings cycle. Next week is going to be very busy, especially for the FANG stocks. On Thursday, October 25th, we get Google, we get Amazon, we get Intel, we get Twitter, we get a number of FANG stocks, a number of tech stocks. Thursday's going to be a big day for earnings. But next week is also going to be big because we get Monday, we get Halliburton, and then a small regional bank, Zions Bank, which I've always liked. Tuesday, we're getting Caterpillar and Lockheed Martin. Keep in mind, Lockheed Martin's at risk with the Saudis because they sell a lot of defense products to the Saudis. So you're going to see a lot of him and Han on that earnings call based on what happens with the Saudis and what they cut and what they don't cut. And Trump this week in his own record is saying, I don't want to touch that. So at the end of the day, money and oil always wins out and always trumps over other stuff. At least that's kind of my initial take. But that still doesn't, stop the markets from just price action reacting right away. Wednesday, we get Boeing, we get Ford, we get General Dynamics, Microsoft, part of the FANG, and Visa, which is part of consumer spending. So, and then, as I said, Thursday, we get the Google, Amazon, Intel, Twitter. So big earnings. And then also Thursday, we get the ECB's interest rate decision. Okay. Nobody's expecting the ECB to raise their rates, but they're going to be paying attention to what Super Mario Draghi says on a go forward basis as far as their stimulus. And then Friday, we get the US GDP number, first pass for Q3. The forecast is expected to come in around 3.3%. Now, last quarter, as you know, the final print was 4.2. So a little bit of a pullback to 3.3, but that's still a very strong, healthy number over the 3% benchmark that the Trump administration was looking for on average all year long. So we've got a lot of activity coming up this week that can really bounce the markets around. Now, what I did on this screen here, as you can see, I've got a number of percentage drawdowns. You can see here where we finished the week from where the highs were made back in September 17th. We're down 6.09% from the highs in the S&P. Okay. Just to give you an idea, a 10% pullback is around 26.51. That gives us an official correction in the markets. Remember, the markets deem a correction as greater than 10% from the highs, the recent highs, and less than 20%. Obviously, over 20% is deemed an official bear market. Now, I've got a line on here at roughly 2,600. What is that? That represents how far back we pulled back last January. If we come back to last January, this was the high last January. This was the trough last January when we had this huge pullback. It was 12%, representing 347 points because the index was a little bit higher at the time. And it did all of this in less than 2 weeks' time. Okay, 12%. So here, it's a little bit slower. You can see this is 1 week, 2 weeks, 3 weeks. We're 4 weeks into this downdraft, not 2 that we had in January, 4. And we're down 6.09%. To equal January's pullback of about 12% would take us down to 2,600. Now, everybody on TV, the talking heads, and everybody's talking about we need a flush out before we go higher. And technically, that's what they're going on. They're going on the technical patterns of the chart that would suggest we're going to get a flush out, and then the markets will be free to consolidate, and then money will come in. A lot of big money is talking about buying in the 2650 to the 2725 zone. All right, that would imply that we would go down to almost break even for the year before money starts to really come in and start buying on earnest. Now, that's not to say that we can't move up from here. Anything can happen, but we've got these key levels that we need to watch. Okay, so now what are those key levels? If you look on this weekly chart, in fact, let me take it back down to a daily chart. And I've got all these lines in here, and then I will start bouncing around on them. You can see here's this yellow line is the 200 EMA. It is essentially now flat. The 50 EMA has got a downward vector, meaning it's pointing down towards the 200 EMA. Okay, so I'm going to expect that gap to close. The key for me, a couple of key levels. One is the 200 EMA, which is sitting right on this lower level of an upsloping regression line. Where does this regression line start and how does it play out? So going back to the weekly, let me come back in time so that you can see. Right here, this starts at the lows in the summer of 2016. Now remember, it doesn't look like a lot. The markets were less priced at this time, so a percentage move is less points, but it's still just as insightful and impactful. In the summer, April of 2015, we had a 15% pullback, 322 points off the highs at this time around 2133. And it gave us these lows right here. That was the last large, insightful pullback. And then you can see over here the post-Brexit vote right here where we pull back. And then we've got the where we were pre-Brexit at 2119. And then after the Brexit, 1981. Then you can see here the overnight Trump election lows of 2028. So you can see some of these major events going back to 2016. Now, I started the regression line at the trough of 2016. And running up, you can see we only broke at one time, but it didn't hold for the week. And that was in the Trump overnight election. And then for our members, we were up at 2 in the morning playing that. And if you guys recall, we were going long the Dow at 17,500. Turned out to be a really good number of months for us in the markets. Same thing with the Brexit vote. In the Brexit vote, we were up at 1 and 2 in the morning calling the election, looking at the polling stations on the internet, and then we played that as well really nicely. But look at the lower regression line, the red line here. You can see the last time we challenged that, 10/31/2016. Then we challenged it again in this sell-off that we had in January, February. We came right down to that line. We did not go below it. And then in the retest of that line back in April, we came down slightly below it, but we did not close below it on a weekly basis. So there's only been just a couple of tests. And both of those tests, we stayed above the regression line. So now let's fast forward to today. If you look on this weekly chart, we've tested the line again. But on a weekly basis, both times, we've been able to maintain and close above this red regression line right here. So this is going to be one of my key areas on a weekly chart and actually a daily chart. Okay. If we blow below it and we close below it on a weekly, not a daily, but a weekly, then we can anticipate more downside action. On the daily, if we take out the 200 EMA, then I believe the odds dramatically favor a retest that we made back on October the 11th, last Thursday or Thursday before last. That is what I think most market participants expect and are looking for. That would take us down to around the 2,700 level, which, by the way, is only just a one-day fall to go break even for the year. That'll jack up volatility, probably back up to 28 to 30 in the VIX, maybe 32 in the VIX. And I'll show you the vol chart in a minute. We'll see everything jack. It'll be a scare the children moment. And then I think you're going to see big money start to come in. So the question has always been in my mind, we're going to get a bounce. And is this bounce going to hold or is it going to crash? Well, we came down here. We got a bounce all the way up to here. And now we're working our way back down again. So the question is, will this break and come down and then do another one of these bounces here and then start a steady stream higher? Don't know yet. We're going to have to watch these key levels to see. And if anybody says they do know, they're full of, horse manure, because they don't know, because no one knows what the future is going to bring. All we can do is trade these key levels, and it will determine our level of bullishness or our level of bearishness. Right now, the charts seem to indicate on the earnings side, earnings are holding the markets up. We've got, as I said before, 72% of companies are topping their forecast, or 72% of the companies that have already reported are beating bottom line numbers, but only 58% are beating top line numbers. And those that don't beat their top line numbers, which is 42%, on average, they're getting punished to the tune of about 5.7% to the downside. This week, we got some big earnings coming out, especially in the FANG stocks. And because FANGs have been leading the way in the past, should they falter, I think that'll be enough of a catalyst to move us down. In fact, the markets always being a forward pricing mechanism may start to sell off before that event. And if they come out solid, then we'll get a bounce. Okay. So the odds in my mind favor a little bit more of a flush out, a little bit more of the scare of the children, get more retail traders out of the market, consolidate somewhere down in this area here, plus or minus the 2018 open price, and then our 2018 open price. And then we'll start to see a climb back and then regain the 200 EMA, which would be a sign of the times. And that's kind of what I'm looking for right now. So that means near term, over the next week and a half, I think the odds favor more downside than upside in looking at these charts. Okay. It's a very simple proposition. The other thing is on a weekly basis. Now, for those of you that follow my updates, I pointed this out. And I told you guys, we can expect some weakness. And I said, bear call spreads, bear put spreads, bear call spreads for the credit spread side of the house, or bear put spreads for the debit side, which is probably more favorable in rising volatility. You can see here this major bearish divergence. Now, we call this a poor man's bed. In our group, it's not as solid of a bed as others. And for those of you that are members, you know how we rank these things. If you're not a member, I highly encourage you to come in, because we're usually on the right side of the market. All right. We're never looking to get the highs and the lows, but we're always going to get the bulk of the move. Okay. So we had a warning here back in, actually, we had this warning back in early September after Labor Day weekend. We had this warning that we could expect a little bit of weakness in the markets. Now, you just don't know how much weakness. The weakness can be just 20 or 30 points, or it could be 100 points, or it could be 200 points. We're down right now about 179.5 points from the highs. And I still think we got another 3 to 5% to go to flush this thing out. Will we hit correction territory? We could. Correction territory takes us down to 2651. That'll be enough to scare everybody. And then I think we'll start to see the forward guidance PE ratios come in fairly valued given the current strong earnings. Even though I get 2019 is going to be lower corporate growth, it's still strong growth going back a decade or two, very strong growth. So I think we're going to see the markets build. But in order for the markets to build and more money to come in and to get more money off the sidelines in, I think we got to get those valuations down just a little bit. So even though it's sitting at 15.9, we got to get them down. Remember, the summer of last year, they were sitting at about 21.2 or 22 for forward earnings, right? And they've come in over almost 6.5 points in PE ratio. That's a huge drop. So that is going to help the markets consolidate. Now, if we come back to a daily chart again, and we come over and we look at the Dow, okay, the Dow finished up for the week. Look at the Dow. It is nowhere near the 200 EMA, not like the E-minis. The Dow is showing a stronger chart, but the Dow is also on an annualized basis, on a return basis, compared to the 2018 open price, closer. So we could come down in that flush out with the Dow and come down a little bit lower around the 200 EMA, which takes us down to around 25,000. That's another 400 points south for the Dow, 500 points south for the Dow. Wouldn't be surprised to see it. And then we'll start to see interest building again. Let's look at the Nasdaq Futures, which is really had 3 down weeks in a row. And you can see here, again, it's structurally, it's got a chart not quite as strong as the Dow, because the Dow hasn't been below the 200 EMA, but you can see Nasdaq has just one day that it closed below, and then we quickly came back up to the 200 EMA. But we're sitting here, and again, you can see 1, 2, 3, 3 down days in a row for Nasdaq this past week. And the odds favor us to come down and test this upsloping trend line right here. So again, same thing with the Dow, but we're well north of the open price, 2018 open price of the Dow, well down here. So I don't see us coming down that low, to be honest. I do see us possibly breaking the 200 EMA in the Dow. Now let's look at the Russell. That's a little bit of a different story. Look at the rut, guys. The rut is flirting with the 2018 open price. All right. We close below it and we move back up above. The rut is almost flat for the entire year. Now, the Russell is small cap and mid cap. And the reason why that it's selling off is because it's more of a vote of the US economy than anything else, because small cap and mid cap have less exposure to international sales than the Dow and the S&P. And it's not as loaded as the tech, which is, or Nasdaq with all tech. So you can see here, small cap, mid cap, we're well below the 200 EMA, the 50 EMA. If we get across in the 50 EMA and the 200 EMA, that's not going to be good news. It's holding the 2018 open price. I think we're going to go back below zero. I think we may see a close below zero and the Russell move into the red for the year. Now, remember, the Russell was in the red for the year earlier this year, while all the other indexes were up 5, 6, 7% for the year. The Russell caught up. At some point, if the Russell continues to go down, it's going to drag the other indexes down as well. So this week, in my mind, is going to be a real key week for just how much further down we're going to go. And keep in mind, when you have a market that opens up like we did on Friday and moved up around 28, just slightly under 30 S&P points, and then closed for the day down, okay? And it closed for the day down below 4 or 5 points. That's more bearish. And when you've got a market that typically in strong up bull markets, it ignores bad news and only focuses on good news, and that moves the markets up. In more of a bearish type market cycle, it ignores all the good news and focuses only on the bad news. So that's the sentiment that we're in right now. And it's going to be like that until, like I said, interest rates and valuation and that fair value is established in the market. It is, even though we've been moving down hard, it's been a relatively orderly move. Okay. I mean, I know we've had a couple of scare the moment days with the markets, but it hasn't been really wild. Not like last January, where, as I showed you, it only took 2 weeks to go all the way down. Here, we're in week number 4. So that just shows money is coming out as interest rates go a little bit higher. And that battle continues between, now it seems like more of the TV talking heads are doing it. And they're complaining against Jerome Powell raising the rates when inflation is really not that strong. It's almost like right at 2%. So, I think if the feds were to come out and say we're going to look at and look at adjusting our interest rate policy, you'll see the markets bounce really hard on that. Okay. But he's not in that mood right now. If we look at volatility, and let's go take a look at the VIX. Okay. And this is if we had that scare the children moment, you'll see here that last time we had that, a couple of Thursdays ago, the VIX went up to right here. All right. Right around 29. Okay. Now it didn't close there, but that was the scare the children moment. We're sitting now at about 19. So that's about a 10-point move and 10 Vega point move in the VIX. Okay. That is, if you were to take that and just take a look at it on a percentage basis, that's about another 52% move higher in the VIX. And that can happen very quickly. Okay. I don't want to compare this to this past January. And the reason why is that was an unusual event. What made it unusual, if we come back to January, and I'll show you, this is the January event right here. If you look at the VIX, again, it came up and it settled around 37.5. It went all the way up intraday to around 50, but it settled right here. So that was kind of the normal settle, and then it started moving its way back down very quickly. Okay. But what got it up here was the number of short positions by big hedge funds. They were overly short the VIX futures. And when the volatility started going up, those short funds had to close their short futures, and they closed them by buying the close. And they did all of those orders right at market close. There were hundreds of thousands of buy orders coming in. That is what catapulted and cratered XIV. It went bankrupt. XIV just liquidated it. A lot of people lost money. And then VIX settled in very quickly. The very next day, it came back down to around 30. So when you get into this red zone here, that is the scare the children moment. Margin calls happen. Money starts selling everything. And in this wick right here, and we went all the way up to right at 50, that's what happened. Okay. Could it happen again? Yes. But I don't think we're going to have that level of scare the children, because I don't think the hedge funds were as drastically short volatility now as they were back then. Because remember, this was the first spike in vol for a year and a half. 2017, we had like maybe 4 or 5 days for the entire year where the S&P moved more than 1%. So fast forwarding to today, and looking at the VIX, you can see right here that if we do go below zero and we have that scare the children moment, I think the VIX can get up into the low 30s, okay, from the 19. I don't think it'll double, but again, we can get up to these low 30s, even up to the 36.81. If it gets up there, for those of you that are brave enough, I would highly encourage you to buy a couple of puts in some volatility indexes. Now we've got some trades going on in volatility now. We're underwater a little bit because we're having an extended period of time. We're going to end up having to hedge those trades. But I believe once things settle down and we get that consolidation, you're going to see all the money coming back out of volatility. But for now, for the next week, maybe 2 weeks, through the month of October, which, by the way, is also a very volatile month historically, we can expect to see some really craziness going on. And then once we get through the midterm elections early November, things will start to calm back down again. And then I think we'll see a nice little reflex rally into the end of this year. Okay. If we look at treasuries, we're seeing, even with the markets going down, bonds are going down as well. That just goes to show that some of this correlation right now, when you have a scare the children moment, typically bonds goes up, interest rates go down. But look at bonds. Going back to the middle of August, bonds, The bond market has fallen from 145 down to 137. That's over 7 handles. I don't think bonds are going to go much lower. I think interest rates are going to stay around these levels, but I don't think you're going to get much of a rise in bonds either, meaning a lower interest rate. If you do in bonds, be ready to short up in this area. Remember, every time the bond market was in this shaded zone here, I was encouraging people to look at shorting the bond market or picking up puts in TLT. All right. And it was a trade that typically lasted for about 2 weeks or so. About 2 weeks, 2 weeks. This trade here, you would have stayed in the trade and done very well in the trade. And now down here is not where you want to be picking up puts in TLT because it's starting to find a consolidation home. Doesn't mean it can't go a little bit lower, but that's kind of what I'm seeing right now. In these charts. Okay. So that would be the Treasury market. And if we look at interest rates, the 10-year, as I said, interest rates have been slowly moving higher. I think we may have put in a peak for interest rates for the remainder of this year at 324. I think they're going to kind of stay in a range bound mode here, just like bonds are going to kind of stay in a range bound, but they're not going to fall too much. Remember, December, there is over a 70% chance the Feds are going to hike the rates again another 25 basis points. So that's going to keep a bid in the interest rate market or in the bond market to the downside. So, and if we look at currencies, if we look at the dollar here, okay, if we look at the US dollar, I'm of the belief that the dollar is having a hard time maintaining this level. And I think the dollar, if anything, is going to fall off the perch just a little bit. Okay. Regardless of what interest rates do. This is really the dollar index. It's not as much the dollar like other currencies. It's based on about 5 other currencies, of which the euro is about 58% of the value of the dollar index. And then you got the yen and the pound, the Swiss franc. All right. Canadian dollar. These are all components of the dollar index. So the yuan is not based on that. But you can see, I believe, the near-term impact of the dollar is down, which would mean, in general, the near-term impact of the euro is up. Now, we get the interest rate decision out of the ECB next Thursday. No one in their right mind believes he's going to hike the rates, but they're going to listen to his forward guidance. If he still remains relatively hawkish, you're going to see the euro move a little bit higher and you're going to see the dollar move a little bit lower. Okay. And we just closed down some great trades in the emerging markets in a couple of countries. One country in particular for our members, we did very well on it, about a 28% return on it. We're going to be looking again in another week or so of setting up a similar trade. So stand by on that one for our members. And I'll go into detail on that this Sunday evening. Gold, again, I am not a believer in gold. I know some people are. I am not. I believe even though gold broke out at this level right here, in fact, I could probably, let me just zoom out right here and I could draw this level in right at that level right there, right? And you can see how gold is trying to break out of this level right here. And we've been making some breakouts, and you could probably rightfully argue that this is a bull flag or some semblance of a bull flag, right? With the pole right here, and then you got this bull flag sitting right here. The risk of the next move is to the upside, and the distance of the move is roughly the width of the flag at the widest point, which would put us up challenging the 200 EMA over the next week. If we get a scare the children moment, wouldn't be surprised to see gold go up here. If it gets up in this level, I'm going to watch how it reacts to the 200 EMA. If it starts to pull back, I'm going to watch how it reacts to the 50 EMA. That is going to determine whether I want to put on, a little bit longer duration trade long gold or GDX. GDX is a gold miners ETF, which, has done fairly good in this move higher here. If we look at GDX, you can see here, this bounce here is a little bit stronger in GDX. It tends to run a little bit stronger than gold or GLD, but the same kind of pattern exists. All of this selling right here has put a lot of shorts in these products. So some of this is short covering. So be careful chasing it up here. We need to let it have a few weeks to either consolidate or pull back. And if it pulls back, just like gold, and kisses the 50 EMA and then starts to move higher, that would be the long entry. Okay. And for our members, we'll go into more detail on that. Oil. Oil is another one where I'm taking a little bit of a contrarian play on. I believed that oil was pulling back, probably to the mid to lower 60s. And look at what it's done, guys. Everybody was bullish oil. And if you've been following me here, I've been saying be more bearish oil near term down to the mid to lower 60s. That puts us down to this area down here of these support zones back down in here. Okay. And I think that is still the case. Now, we could have a little bit of a relief rally here, a bull trap, but I still believe oil is going to go a little bit lower. So for those of you following me, this bully you've probably been able to profit from it. For our members, we'll go into more detail on this and where I see opportunities. If we look at Brent oil futures, this is more affected by the Iranian oil embargo than WTI. But you can see Brent is also down. It hit a high of about 86.72 and then has pulled back. It tested the upsloping trend line. Now it's testing the 50 EMA. You can see it's sitting right on its 50 EMA, yet WTI oil is well below the 50 EMA of the red line here. Okay. So it is weaker than Brent, which goes in again to my thesis of the spread between Brent, right, and WTI. Look at the spread, guys. Remember, back in this area here, I said go long the spread. It was at 663. It finished the week at 1061. So roughly 4 points. That's $4,000 per contract, okay, in this move here. Now, why is this happening? It's happening because of the oil Iranian embargo. It was kind of like low-hanging fruit. You could see that coming because Brent is more affected by an embargo on Iranian oil than WTI US oil. Okay. So now, once we get up here, there is going to be a moment where we're going to want to go short this spread rather than being long the spread. Right in this area here is where we went short the spread. And you can see, again, it's $1,000 a point, and it went from 11 all the way down to about 2.5. So about 8 or 9 points, $9,000 a contract. But we're going to be playing this. Now is not the time to play this spread. There's a lot of support in this spread around 950. It's sitting at 1050 at this time. I think the spread could widen a little bit more going into the Iranian oil embargo. And the reason why is nobody knows how much oil is actually going to be impacted when this thing hits on November the 4th. India, South Korea, Japan, China, all these companies that have been buying oil from Iran, some of them have said they're going to slow down. Others have signed longer term contracts, but we're going to get reports of what is actually affected. That is going to then drive the spread. If we think it's going to be less than expected, we're going to want to short the spread. If it's going to be more, then we're going to just maintain the long position in the spread. It's that simple. Okay. Now there's other things going on in the energy market with gasoline and natural gas. I'll reserve that for our members this Sunday evening. And then in the ag market, we got some things that we're looking as well. And then a couple of things that we haven't done, but have been very strong. And I love the soft market because there are times in the softs, like look at coffee. Look at that trade, guys. Coffee was on the tear to the downside. Once it broke, that is a huge, huge, huge move in the coffee market. All the way back up here, okay? We can expect some settling in here. Just to look at the strength of that move. If we come out to a weekly chart, you can see here just how much that has moved. It's moved right up to a huge resistance zone up here. Will this move hold? I'm not too sure that it will. Being a contrarian, it would be interesting to look at possible shorts in the coffee market. But right now, we're just watching it very closely. Okay, so we'll cover that in more detail with our members. The other one that we had that we forecasted a long move in. And if you look at cocoa right here, this was the move in cocoa. Remember, we were down in this area down here for the longest period of time. And I had told our members, once this breaks, it is going to run, and run it did. Okay. And all we're looking to do in our commodity market trades is find these market imbalances and trade the contrarian move. Okay. And there are ways to do this with ETFs or stocks that are driven by cocoa or driven by coffee, that make it a little bit easier to do. Okay. Anyway, guys, that's our weekly roundup for the week. I hope you enjoyed it. Members, I'll see you this Sunday night. Folks, if you're not a member, I highly encourage you to come in. We got some really cool things. I think 2019 is going to be a really bang up year. This year's working out really nicely, but I think 2019 is going to offer some even more opportunities for us with some of these market imbalances that have occurred in the commodity market as well as in the equity markets. Make it a great weekend, everybody. Members, I'll see you this Sunday night. Take care, folks. Ciao.